Hi, everybody. Welcome back to another edition of VCTV. I'm your host, Kyle Ellicott. We've got a fun episode again for you today here on Tuesday, 4/20, also known as Doge Day around the cryptocurrency world. So shout out to those in that space. We're going to be talking today about opportunity zones. What are they? What do they mean for you as investors and entrepreneurs, and how to look, think, and take advantage of these opportunity zones that can be very beneficial to your business or into your portfolio as well. And I'm joined by two outstanding co-hosts today from around the world that will be sharing a little bit more about themselves. But first, make sure you check us out on latoken.com. Click subscribe, share today's episode, give it a thumbs up, and also check out the entire family of VCTV speakers around the world. A big thank you to the Latoken team and to Maria for making today's episode possible. I'm your host, Kyle Ellicott. Let's go ahead and welcome Dr. Shikoth. Welcome back to the show. It's been a few minutes. A little introduction and background.
I hope there is no echo or any audio issue at my end. As the books behind me suggest, or yeah, there are books behind the books and the books. I mean, it's like a what's that Inception dream. So I'm a legal counsel. So I act as a counsel for various fund houses, various family offices. I started my career as a city banker, moved up the hierarchy in the city trade division, and then entered the investment banking. I also act as a mentor for the government of India on the Niti Aayog, and so here to talk about opportunity zones, and we in India, we are relatively newer, I would say, geography for opportunity zones, because we just introduced something called insolvency and bankruptcy code. So looking forward to the discussion on that as well.
Wonderful. Thank you very much. David, welcome to the show as well. A little intro, a little background for everybody.
Yeah, thanks, Kyle. I'm basically a financial economist, and I have spent most of my career managing money with a short stint as the chief investment officer of a billion-dollar trust company. I've been in academics, still are in academics. My research is mainly in machine learning and artificial intelligence models, and I'm mainly in the hedge equity space. So the opportunity zone came about where we had clients over the last few years that have accumulated sizable capital gains that we needed to figure out how to park those capital gains and or defer the taxes. And during the last administration, the opportunity zones became a reality, and good friends, clients, investors that are in the real estate space, the development space, introduced us to these opportunity zones. And now I wouldn't say I'm an expert, but we are investors in these zones, and I've got a pretty good knowledge of how they work and what are the advantages and disadvantages to investing in them.
So with that being said, David, give us a little context as to what opportunity zones are and kind of why we should be paying attention to them, maybe now more than ever, especially here in the United States, as they are more of a trending, have been a more trending area of focus outside of the US, but now here in the US. Give us a little context as to what they are, why they're important, and
Sure.
why now.
The opportunity zone basically was established by the government, federal government, that was trying to get investment capital into areas within the United States that had been designated as opportunity zones, where development in the real estate space, whether it be office space, whether it be commercial, industrial, single family homes, multifamily homes, where it would encourage capital to go into these areas to private investment firms that would then go in and develop each one of these areas based on the specifics that were outlined by the federal government. The main incentives, and some of these incentives have passed, I think we have another milestone here in June, is an investor that has built up sizable capital gains can invest into one of these opportunity zone funds, and within the fund they get a deferment of their capital gains, and as long as they hold the investment within the opportunity zone, which normally will last about 10 years, there will be discounts anywhere from 5 to 10 to 15% of transferring those capital gains into the fund. Another really wonderful aspect of it is if you hold the investment, any of the gains from your initial investment over that 10-year period can go tax-free. This is not a liquid investment. Some of the funds, or actually most of them that are more established developers, will pay dividends. They will pay out cash flows annually. But the real benefit is the deferment or the tax-free nature of the growth that occurs within the fund for the real estate development. So that's pretty much it in a nutshell. Obviously, there's different nuances, but it's a great alternative to the credit markets, which we all know. When you got the risk-free rate in the government bond paying you the 10-year 1.5% negative interest rates in Europe, there's some real opportunity here to make some pretty good returns compounded over a 10-year period.
Thank you very much, David. Dr. Shikalath, anything you want to add on that, but also what are you seeing on opportunity zones around India, maybe Southeast Asia as a whole, to further David's point?
So, David, I also happen to be a certified accountant. So, I'm going to don my numbers hat over here, and I'm going to double down on what David just said. And the opportunities are quite similar in terms of the jurisdiction, and we spoke about this in the previous panel as well, Kyle. The tax angle that is required when you seek an opportunity, especially distress funds and geographic location based opportunities and so on and so forth, or sector based opportunities that are available. So we in India have evolved something, or globally there is something called a pre-pack. So before you head into an insolvency, or before you head into any kind of negative connotation, there is a package solution that are available, and which is much like the solutions that we used to find in trade and economics in the 2005 and 2004, where multiple products were packaged and so on and so forth. So the opportunity zones are just going to be a geographical dimension to the whole conversation that we had 15 years back. So I would agree with David's statement, especially around tax planning. The only thing is the opportunity zones that are being created, the opportunity funds that are being created, typically tend to be viewed with a negative connotation that they are avoiding taxes and they are using that as a tax escape mechanism. So that is something that a fund should keep in mind, or entrepreneurs should keep in mind, as to where the money is coming from and how the money is being or being perceived from the last thing that you would want is government or the IRS going into your books in audit.
So with that being said, for both of you, where's the investment opportunity for an entrepreneur? So if an entrepreneur is looking to start taking advantage and building within an opportunity, what should they be thinking about? And then I want to flip the conversation around investors as well. But let's start with entrepreneurs. David, first on your side, as an entrepreneur, big, small, medium, large company is looking to start building within an opportunity zone. What should be their thinking? What advice do you have for them to get started in those spaces?
Yeah, I think for an entrepreneur, if you are you can acquire capital and you have access to higher net worth individuals or those that are considered qualified or qualified purchasers, and you have a network that you can team up with developers that know the area, know the space, and can leverage the subs and ramp up a project very quickly, the entrepreneur can come in and build a business within a fund structure that your traditional hedge funds are built on, where you domicile them, say, in Delaware or Nevada. You could even domicile these funds in the Caymans, Bermuda, Bahamas, Singapore, where you have a tax neutral site. But I think the entrepreneur, what they're going to need to do is have access to capital. Most of these funds are ramping up with anywhere from 100 to 250 million. And what they're able to do is deploy that capital very quickly. They need to be able to go in and identify the land, the zone. They need to be able to tie it up from the purchase side. And they're going to need to be able to know who the developers, the construction companies are within that area, particular area. So it's a very competitive right now. But if you have access to land and you can purchase the land, then you're going to have a much better chance of developing these funds, because the land right now is what everybody's trying to seek. And those landowners, they're, as we call it, they're catching a bid, and they're really price takers right now, or the entrepreneur is. So you have to be willing to go in, put your business plan together, and make sure you're not paying too much for the actual land that you're acquiring.
Thank you. Dr. Shirkoth, anything to add on that? Again, opportunities and advice for entrepreneurs looking to begin in opportunity zones.
So I would rather go the x-axis and the y-axis way, or the graph way, which is a geographical investment in opportunities, which is tax friendly, investor friendly, and so on and so forth. So to answer your question directly, as an investor, I would rather urge the investor to seek out, if they have direct access to capital. The first point of contact should be family offices, because they have large amounts of capital to deploy, and they can be a considerable partner, and they have a network of individuals as well. So, but that only solves one end of the spectrum, which is the inclusivity side. So what we're talking about over here is from an opportunity perspective, from a distress perspective, or from a geographical perspective. Then we need to see who's interested in that particular geography and that particular. For example, in India, I'm told that 80% of the disputes which are pending before a particular tribunal / court / circuit court is pertaining to distressed assets, and these distressed assets need range between $1 billion and $1.5 billion dollars. So for an investor or an entrepreneur, maybe the right point would be to see where the investments are typically being made by these investors who make these pre-packs or the pre-packaged insolvency programs, and then look at possibly the sectors where which typically attract the investments, and to make it a comprehensive solution for an investor. So do not make it a simple bargain, or do not make it a X product, or do not make it a mango or a strawberry or a dragon fruit that you intend to sell. Just make it a basket of these things that you intend to sell as an opportunity.
Thank you. And David, now switching those gears to investors, I mean, investors looking to start investing in opportunity zones, what advice do you have for them now, specifically here in 2021, as we know this is going to be a waterfall moment here in the United States, but globally as well? We're seeing more access to opportunity zones as well.
Yeah, I think the investor needs to understand that these are not liquid investments. And if you want to take advantage from the taxes, certainly in the United States, you need to have a long-term perspective, and that this sort of investment is going to be tied up. The capital will be tied up for 10 years. Now, depending on the fund that you invest in, They may have some liquidity moments, but if you really want to take advantage of the full returns that you are going to get over the period, your investment's going to be locked up anywhere from 7 to 10 years. So that's very important to understand, that there is not a liquidity piece of this. And by giving up that liquidity, you will earn, anywhere from, over the 10-year treasury rate, which is now around 1.5, 1.6%, within the United States, and we have a negative real return, you can get anywhere from 600 to 800 basis points annual ROI on your investment. And not to mention, as the investor, that growth that occurs, as long as it stays in for that 10-year period, is going to be a tax-free. So by you giving up liquidity and by you tying your funds up for that 7 to 10-year period, your net returns can be fairly sizable, excluding you don't have to put your money into the bond market and basically get paid nothing, and you have collateral that's associated with it by being in the fund. So the trade-off for really no liquidity over 10 years and possibly dividends that are paid is potentially double-digit returns compounded annually.
Thank you very much, David. Dr. Srikanth, anything to add further onto that point? And again, looking at opportunity zones on a global scale, what investors should know at investing in these?
So the investor is spoiled with choice, right? When it comes to opportunity zones, especially after COVID, there are if I look at my family offices, if I show you some of the emails which I wouldn't, but if I were to hypothetically show you some of the emails which have been forwarded by the Forbes 100 to me directly. Saying that these opportunities are available and these investments could be made, I find them so there are so many people who are attracting the same investor from different angles. So that being said, I think from an opportunity zone perspective, it is more of a bid, and it is more of a collective bid, and more of a situation where you discover the price. So that being said, always realize that when one in the end on one end, when the seller is discovering the price, the buyer is also discovering the price, right? So that's how a typical bargain works, or at least economics 101. So that being said, globally there are a lot of opportunity zones that are opening up, designated opportunity zones. In different jurisdictions they are called different names. In India, we have called it an IBC. In Singapore, we have a pre-pack, and so on and so forth. I think the IRRs that the Indian investor is looking at is a little higher than the treasury rates, because that is comparatively. So if I may just give you a sneak peek into the IRRs that the Indian investor would be looking at, that stands at an IRR of 18%. So that would necessarily mean that they are looking to exit the fund in 3.5 years, compounded. It may seem ridiculously high, but that is the expectation out here.
David's shaking his head as well, so it seems like an expectation all around. But with that being said, gentlemen, I want to come to both of you for closing thoughts and big advice looking ahead for the rest of the year as to what all sides need to be aware of and where maybe some of these exciting opportunity zones are available. And then of course, where can you be found online? So Dr. Srikanth, to you, closing thoughts, and then also where can you be found online for those looking to continue the conversation?
So opportunity funds are the future. If you are a company which is in distress, or you are a startup which is done quite well, and the first thing that you should be looking at is consolidation, and then you should be looking at targeting with these opportunity funds. On the other side of the spectrum, fund house managers have a lot to manage when it comes to opportunity funds. Now is the time for price discovery. So I feel globally it's relatively a newer concept. It may have exploded in the Western world quite early on, but it's quite new in this part of the world, at least. So my closing thoughts would be: let the market settle down a little bit on these opportunity funds. But in the process of settling down, do not miss out on the returns. Is what my advice to the fund houses would be. And where I could be found on LinkedIn, Dr. Shrikant Patsarthi. Please get the name right. And you could find me as arbitrator, Dr. Shrikant Patsarthi, and you will find a list of about 10 degrees behind me. So that would be a good indicator of who I am. So apart from the other Shrikant Patsathis that you find on LinkedIn, so that's the differentiating factor.
There you go. Thank you very much, David. Same to you. Closing thoughts. Where can you and your fund be found online as well?
Yeah, I think closing thoughts are these opportunity funds that are located around the globe are going to be great alternatives to the traditional bond market and credit markets. As we see that around the world, within Europe, Asia, the United States, your traditional credit markets, investment grade paper, you're lucky if you're going to earn anywhere from 2 to 3% on speculative paper that you have to go out at least 10 years. So as an alternative to that, these opportunity zones are excellent investment vehicles. If you are willing to give up some liquidity, you have opportunities to make sizable returns over your traditional credit markets. And I think that for the entrepreneur, we're already seeing your traditional land developers and construction companies coming together with capital to really improve these areas around the world. So new jobs are being created. You're seeing new businesses and startups coming into these opportunity zones. I think that when we look at that public-private partnership, this is truly one of those things that I think we're going to look back 10 plus years from now, and as a global environment, international environment, people are going to be real excited, from the investor to the developer to the new jobs that will be created because of these opportunity zones. And to get a hold of me, I'm on LinkedIn, just David Mascio, and I'm always open to talking and learning about other opportunities that are out there, and we welcome the conversation. So I appreciate, Kyle, you having me on, and look forward to the next time we have a show.
Wonderful. Thank you very much as well, both of you, and looking forward to having you both back many times over here on VCTV, and welcome to the VCTV family as well, David. With that being said, audience, thank you so much for tuning in. Make sure you click subscribe, like today's episode, share it as well, and make sure to reach out to both David and Dr. Shrikant online, and make sure you add context where you heard them, where you met them, and what you would like to continue the conversation about as well. And a big thank you to the LaToken team and Maria for making today's episode possible. Check us out on latoken.com. I'm your host, Kyle Ellicott. You can find me again along with my co-host today online. We'd love to hear more from you, so do please reach out. With that being said, everyone have a wonderful, wonderful day, and we'll be back here tomorrow with more VCTV. Take care, everybody.
Thank you.
Bye.